Hey, everybody. I wanted to talk about chapter 4 here, talking about personal taxation. So, same deal as last time. The reason that I'm doing this, I'm assuming you've already read all the material, and I'm just trying to clarify and make sure that I hit the topics that are likely to be on that end of the chapter exam that you're going to face here once you finish. So, yeah, we're going to talk about the purpose and types of taxes. Got all kinds of taxes. We're going to spend most of our time talking about the federal income tax, but of course there's sales taxes, there's state income taxes, there's property taxes, several others too that don't get as much attention. When we talk about income taxes, then we got to talk about how to calculate taxable income. We'll talk about marginal and effective tax rates. Basically, the idea there is the marginal rate is what you're paying on the next dollar that you earn. The effective tax rate looks at your total tax burden and compares it to your income. That's your effective tax rate. It matters. It wouldn't matter if we had a flat tax, but it matters when you have a progressive tax like we do in the federal income tax, meaning that the more money you make, the higher a percentage of that income you pay in taxes. So as you earn more, you're also paying more in taxes. We'll talk about some tax credits that show up. Then we'll talk about payroll taxes, Medicare and Social Security, mentioned them just real briefly in the last lecture. And then finally, we want to talk about tax planning. And really, it's kind of interesting. When you say tax planning, the goal of most people here is tax avoidance. And that sounds like something that maybe isn't kosher, right? When you talk about tax avoidance is we're talking about minimizing taxes. That's totally legal. It's normal. It's something that we expect everybody to do. Tax evasion, on the other hand, is illegal. Tax evasion is deliberately, fraudulently underpaying taxes. And the key there is that you're not just planning to minimize taxes, you're going beyond that and misbehaving. And that's a criminal offense. So tax evasion is illegal. Tax avoidance is completely normal and legal, and we expect that people are going to plan their situations to minimize their taxes. So why do we have taxes in the first place? Well, governments have objectives that they want to accomplish, and those objectives are expensive. And so they have to raise funding somehow. They do that through taxation. So part of it, maybe we're building infrastructure, highways and roads. A lot of times we say those are intended to be funded by gasoline taxes. The idea that the people who are driving on the roads should be paying for their costs. Maybe we're providing social welfare. So we've got some folks who could use some assistance, and we use taxes as a way to redistribute wealth from folks who have lots to folks who don't have very much. That might be a goal of taxation. National defense, that's something that we all have a responsibility to pay for if we expect that to happen, so that's tax funded. And there could be other public services as well that we talk about there. When we talk about types of taxes, I mentioned it before, income taxes, both at the federal level and the state level. Some states don't have income taxes. Florida, for example, doesn't have a state income tax, and that's deliberate. So what they're trying to do is attract wealthy retirees down there so that they don't have to pay state income taxes. And then the thought is you can use that as a recruitment tool to get people to live in your state. They're still paying other kinds of taxes like property tax and sales tax, and you're hoping that that's going to make up the difference. That's the strategy anyway. There's a couple states that don't have a state income tax. We have other states that don't have a state sales tax. Payroll taxes, Social Security, and Medicare are the two primary ones that you know about. You're paying those if you have a current job that is withholding from your income there. And then property taxes. If you own property, you're paying taxes. If you don't own property, you're still paying property taxes if you rent. It's just that you're paying it indirectly, right? Your landlord has to pay property taxes, and they're passing that cost on to you. It's just that it's paid indirectly in the form of rent, and you don't see it directly when you do it that way. It's the landlord who actually has to pay the tax, but they have to recover a way to do that. So when you look at your income, we say that your gross pay is your before tax income. And then we are withholding some income from you. And then after we subtract off those withholdings, well, that's what you take. That's your take-home pay. That's your net pay. Some of those withholdings are taxes, and they're mandated by law. So we've got Social Security taxes, Medicare taxes. You'll have to withhold for federal and state income taxes as well out of your income. That's how we collect those taxes, is we withhold them from your paycheck. Imagine how different it would be if at the end of the year the federal government sent you a bill. and said you must now pay your taxes. By using paycheck withholding, they make sure that they get paid up front, and that's deliberate. That idea actually was proposed by famous economist Milton Friedman, and he later expressed regret for making that decision or suggesting that as a possibility, because he believed ultimately that meant that governments were spending more. In other words, if you had to bill people at the end of the year and hope that they would pay, then it might result in less revenue. That was the thought. But by paycheck withholding, then those who are responsible for levying the taxes, they get their money up front. They're taking it from you as you earn it. In the case of both federal and state income tax withholding, we have to compare what we've taken from you to what you actually owe. And that's why you file an income tax return at the end of the year, right? Usually by April 15th, you have a responsibility to file an income tax return. And what we're doing is we're comparing how much income tax has been withheld from you to what you actually owe. If we've withheld too much, you get a refund. Most of the folks who are in the college student age group are likely going to be receiving refunds. And the reason is when we withhold taxes, we assume that what you're earning is going to be constant throughout the year. So if you say you're only working in the summer, but you're working full time in those summer hours, they're withholding as if you're working full time throughout the whole year. And what that means is they're probably withholding too much. When you file a return, you'll get a refund. So for most people, we say that even if you don't think you're going to get a refund, it's a smart strategy to make sure you file a return. If you do owe tax and you don't file a return, well, that's a crime. That's a problem. So anybody who owes tax has to file a return. And anybody who thinks that they might be entitled to a refund should file a return. So that's usually the strategy we talk about there. So when we talk about payroll taxes, we're usually talking about Social Security and Medicare. Sometimes those two programs combined are referred to as FICA, which stands for Federal Insurance Contributions Act. Yeah, it's a contribution, right? In the same way that you might make a contribution to somebody if you park in a bad neighborhood to watch your car, right? You should make a contribution. That's a joke I read once that I always think about anytime somebody talks about FICA. Makes it sound like it's voluntary. It's not. When you earn income, your employer is required by law to withhold Social Security taxes from you. That's 6.2% of the total. They're also required to withhold a Medicare tax from you. That's 1.45%. So if you're going to handle it as FICA and handle them together, then you got 6.2 plus 1.45, that's 7.65%. And that's sometimes a magic number that you'll see that you should be able to back that out of your paycheck. Sales taxes are probably something that most people here are familiar with. Here it's imposed by states and sometimes local governments. It's not uncommon for, say, a state to have a 6% tax rate and then a local area like a county or a city also impose a 0.5% sales tax or a 1% sales tax. That kind of thing isn't unusual. So you got state and local governments imposing sales taxes on certain categories of things that are sold. And then you have to pay that when you buy those things. And this is probably something you all have experience with. It's fairly straightforward how you calculate it. How much did you pay? What's the tax rate? And you just multiply the two. So yeah, on this slide, we've got an example of how that works. If you buy something for $20 and the sales tax rate is 7.5%, yep, that means on that particular purchase, you paid $1.50 in sales tax as well. And that's just added to the price of the goods or services that you bought. So property taxes are assessed by local governments typically. So a lot of times it could be the state. More often it's going to be a city or a county, and sometimes all three. And they will assess property tax on certain types of property. Most commonly we're talking about houses and land and businesses. But there are some states that impose a property tax on your vehicle. And that's not terribly unusual either. The tax rates are going to be determined at the local level for the most part. And so those rates can vary wildly. There are some states that have a reputation for high property taxes. Off the top of my head, I'm thinking of New Jersey and Wisconsin, for example. And then there's states that have much lower property taxes as well. A lot of times education is funded, K through 12 education is funded through the property tax for states and for local communities. That's not uncommon. So we look at all of these things together, all of these taxes together, and we say that combined, we say that's the tax burden that a person faces. There's a couple different ways to assess taxes. And the big issue is this: do you want folks who earn more to pay a higher percentage in tax obligations? You don't have to do it that way. Some taxes are flat taxes, and that means everybody pays the same tax rate and income doesn't matter. So what happens here is a sales tax is usually a flat tax. It's 7%, and every time you buy something, you're paying that tax rate. At least the rate itself is flat. To truly be called a flat tax, then we're actually looking at the tax burden in comparison to your income. And that's where that particular example may break down a little bit. Some people make the argument that gas taxes and sales taxes are regressive, meaning that lower income people are paying a greater percentage of their income in taxes. And that's generally true because higher income folks have more availability to save some of their income instead of spending it. If you're spending all of your income, then probably a greater percentage of your income is subject to sales taxes. And so that means your overall tax burden is probably as a percentage of your income higher for low income people than it is for high income people. So some taxes are regressive, meaning that they consume a bigger percentage of your income. Our federal income tax is a good example of a progressive tax, meaning that the more you earn, the higher income tax rate you will face on those additional earnings. And so that's what you see, that the higher income earners pay a disproportionate amount of taxes. That's a progressive tax, and that's the income tax system that we've got in the United States. The more you earn, the higher tax rate you face, and that's a progressive tax. And there's a number of implications that flow from that. The big one that gets talked about is if you pay more taxes the more income you make, then the value of anything that is tax deductible is worth more because you face a higher tax because you're at a higher income rate and we have a progressive system. So for example, a tax break for somebody who faces a 37% marginal rate, well, that's a lot more valuable than a tax break for somebody who faces a 22% marginal rate. So the wealthier you are, the more valuable tax breaks are to you because you're facing higher tax rates to begin with. And that's just a side effect of having a progressive income tax system. If you wanted it to be equal for everybody, then in a flat tax situation, it would be. But in a progressive tax situation, that's just not the case. So in theory, at least, you'd like your government to operate just like a family does. In other words, that your expenses can't exceed your revenues. You would like to think that there's a constraint there because the federal government ultimately has the ability to print its own money. That is not a limitation that applies to your federal government. And so where we would hope that we have federal surpluses, that would be a situation where your tax revenue is higher than your expenses. You'd hope that that would sometimes be the case. Those are rare. It's much more common every year to run a deficit, meaning that the government's spending choices are greater than the amount of revenue that they're choosing to bring in through taxes. Over time, if you have accumulated deficits, you're going to end up with a federal debt, and that's what we have right now. Federal debt has been large for a very long time. We passed the $20 trillion mark not that long ago. That really has doubled within about the last decade. 10 years ago, the federal U.S. debt, the accumulated deficits through 200 years of the Republic, if you look 10 years ago, we had about a $10 trillion federal debt. That's huge. But in the last decade or so, we've doubled that, and now it's 20 trillion. And that's something that at some point is going to have to be dealt with. The hope is that eventually we'll have enough growth where we can return to surpluses and we can pay down debt. But as that debt gets larger, that makes that possibility less likely. So this slide here is kind of interesting because it shows who actually pays the total amount of federal taxes that are out there. And it probably gives the distribution that you'd expect. If you split up the U.S. population into quintiles, so you've got the lowest 20% of earners, from 20% to 40% would be the second quintile. The highest quintile would be the top 80% of earners and up, 80 to 100%. And you see it's that group that really has the highest share of federal tax liability. This graph is claiming that that group pays about 70% of the federal taxes, even though they only represent about 20% of the population, and they only earn about half of the income. Then this slide shows a little bit about where the federal government actually gets its money from. And you see about half of it comes from individual income taxes. About a third of it comes from Social Security and Medicare taxes. Those are payroll taxes. And then only about 10% comes from corporate taxation, so companies. And then we've got 9% spread through excise taxes. For example, fuel is an excise tax. There might be some other taxes like that that make up part of where the federal government gets its money. But about a third is coming from the payroll tax, and about half is coming from individual income taxes. So when you talk about making changes in those areas, those two areas in particular would have the largest impact, and that's something to keep in mind. When we talk specifically about how do we apply sales tax, so there is a problem like this on the end of the chapter exam that you'll have to take. And the good news is sales tax is fairly easy to figure. All we're looking at is how much did you pay and what is the tax rate, and you're just multiplying across. So the fact that it's on sale, that isn't really considered. It's just how much did you pay. So if you paid $10 and your sales tax is 7%, well, that means 70 cents is what you're going to pay as a sales tax obligation. And it's a fairly straightforward problem. There's really no tricks to that one. The numbers will be different when you get to that question on your end of the chapter exam, but it's simple. You're just multiplying. That's not terribly difficult. Income taxes, on the other hand, are much more difficult to calculate because we have to use income tax brackets. We have progressive brackets where the more you make, the more you have to pay. I don't want to get too far ahead of myself here. I want to talk about income tax returns. So the idea is you have had income tax withheld from your paycheck, and now it's time to settle up. Did they withhold too much? Did they not withhold enough? The only way we find that out is through this filing a tax return process. So this is what everybody has to do by April 15th if you've earned income. You do have to file a return if your income is above a certain level. If you fail to file a return, you'll be assessed a penalty. And if it was the result of deliberate fraud, then that's tax evasion, and all kinds of bad stuff can happen there. If your income is above a certain level, you have to file a return. Even if your income isn't above that level, it's a wise idea to file a return in case taxes have been over withheld, which is a possibility for people who work part-time, especially if you work part-time, part of the year on a full-time basis. Then it's very likely that your taxes have been over withheld and you're due a refund. The return process is how you get that refund. So this slide is fairly long and complicated, but it does illustrate kind of how we assess income taxes. We start out with your gross income. How much did you earn from your employer? And then there are some things you're allowed to deduct from that income. These are called above the line deductions. And then you get to your adjusted gross income. Then we got some more deductions. So basically we have income minus deductions, and then all of a sudden you have taxable income. Then we're going to apply the different tax rates. And so this is going to depend on how much income you earn, because the more you earn, the higher percentage you face. You face it on a sliding scale, though. For example, our 10% tax bracket starts on the first about $9,500 worth of income. We'll get to tax brackets in a second here. And that means no matter how much you earn, your first $9,500 or thereabouts is taxed at 10%. If that's all you made, then you're done. That's the end of your tax responsibility. You're paying 10% on that amount. If you've earned more than that, then the tax goes up to 15%, and then there's another bracket where it goes to 22%, and so on. But the idea is on that first $9,000 in income, everybody pays the same rate. So even if you earn a ton of money, your first amount of money is taxed at 10%. So what I'm trying to get at here is we don't just take your earnings and apply a higher percentage to it. You go through the brackets. It's progressive. So you've got a certain piece that's taxed at 10%, another piece that's taxed at 15%, another piece that might be taxed at 22%. If you stay within that bracket, then we would say your marginal tax rate is 22. On the next dollar that you earn, you will owe 22% in taxes. But you don't owe 22% across your total income. Part of it was taxed at 10, part of it was taxed at 15. And so that's why your effective tax rate is typically going to be lower than your marginal tax rate. Another thing that's going to impact the rates you pay and what the brackets look like has to do with your filing status. So if you're an individual, you have no dependents, then you're filing on a single basis. Maybe you're married and you're filing together. Well, if you have two income earners, then you'd be married filing jointly. That could happen. If you have two income earners and you've decided that you're better off filing separately, you can do that. Married filing separately is a status that you're allowed to use. Maybe you're not married, but you have dependents. Then you're probably filing as head of household. All four of these face different tax brackets. So we have a schedule showing tax brackets, and it's going to depend on your status. Your status is going to impact the rate that you pay. The form for filing your federal income taxes is the 1040, and there's a couple different versions of that. So we have 1040EZ. If you're a single person in particular, you're probably able to file the 1040EZ if you're using the standard deduction and you don't have a fairly complicated return. Also, if you don't have dependents, you can just use the 1040EZ. It's quick and easy. It's shorter. We have a 1040A form, and this allows for different type of income to be reported. So it's not just wages and salaries anymore. Maybe you've got some interest and dividends from investments. If you want to include those, you've got to use 1040A to report that. The straight up 1040 is a standard tax form that everybody can use. The highest earning households are going to use the 1040, but you'll also see people who have a more modest income being able to use that form as well. So a couple different forms of the 1040, but the 1040 is the main federal income tax filing form that we're going to use. Then we talk a little bit about dependents. And so a lot of times when we talk about dependent children, what ends up happening is if you are providing support for somebody, then you're allowed to include that person as a dependent on your tax return, which ultimately reduces your overall tax liability. So we do give a little bit of a break to people who are supporting dependents. Most of the time, those folks are going to be children, right? That's the most common scenario for that to come up. So we have a test to try to figure out, does the child qualify as a dependent? And we've got a slide here that kind of lays that out. So the idea is, did you provide half of this person's support or more? If you provide less than half of the support for that person, you cannot claim them as a dependent. They'll have to file on their income taxes on their own. There's an age requirement that we deal with. Most of the time we're talking about dependents being children, but there are a couple other categories that show up. And then another way to qualify as a dependent is to share an address, to live with the taxpayer. So if you're providing half the support and they're living with you, most likely they're going to be considered a dependent. And the more dependents you have, then the lower your overall tax rate is going to be. That'll be factored in to a couple different places in the tax code, particularly if we're talking about children. Okay, so this is really how we go about figuring out taxable income. We take what your employer has reported. We add in any other types of income that you might earn, maybe income from investments, and then we come up with your adjusted gross income. There's some above the line deductions. And then we've got some additional deductions that we can talk about taking before we get to taxable income. So we start with your total income, and then there's some deductions that we can take off that. One of the big changes that we had at the end of 2017 was a fairly major rewrite of the tax code in the form of increasing the standard deduction. So you have a choice here. You can either take the standard deduction that everybody is allowed to take, or if you have particular expenses that are allowed to be itemized as taxable deductions, then you can add all those up, and if it's bigger than the standard deduction, then you would choose to itemize. That's the idea. So certain things are considered itemized deductions. Mortgage interest is a really common one. Charitable contributions is another. Maybe you've made a ton of contributions to charity and you have a very large mortgage, and you're paying a lot. It's early in the mortgage and you're paying a lot in interest. Later in the mortgage, most of those payments are going to reduce principal. In the beginning, most of your payment is going to pay for mortgage interest. So that's tax deductible. And if the sum of mortgage and charitable contributions and several other categories, if that were bigger than the standard deduction, you would choose to itemize deductions instead. And that means what it says. You're going to list those out on your tax form. And if it's higher than the standard deduction, that's what you're going to do. For a lot of people, the standard deduction is going to be the highest, and there is no calculation to do. Congress just says we're assuming that everybody is entitled to this amount of a deduction. So if you think that's going to be higher, then you'll just use the standard deduction instead. So that's kind of the process. We've got your gross income minus some deductions, and now we get to your taxable income. So here's an actual income tax bracket that we're looking at from, this is for individuals. So if somebody who's filing as a single person, this is the income tax bracket that you'll face. And what you see is that we start out with a 10% bracket. And then that's for the first 95-25 in income that you have for the year. If you make less than that, you'll pay 10% of whatever you earn, and that'll be your income tax responsibility. Once you earn more than that, now we've moved you up to 12%. And I might have originally said 15. I apologize for that. That was misspeak. Where the second bracket is 12%. And that applies on income between 95.25 and 38.700. And if you want to see, look how this works. So what is your tax? Well, they say you'll be paying 12% on the amount in between here plus 952.50. Where do they get 952.50? Well, look, that's 10% of 95.25. And same thing, if you were to check this here, 12% of the amount, if you look at 952.50 plus 12% of the amount between these two numbers, you should get 44.53.50, and then you'll face 22% up to 82,500. And then the brackets proceed from there. The highest tax rate, 37%. You don't get there until you're making over $500,000 as an individual. Now, if you're over $200,000, then your marginal tax rate is 35%, which isn't that far away from that. But basically what you see is you don't really hit these high income tax rates until your income gets fairly high. The brackets are different for folks who are married, filing jointly. All right, so if you're married filing jointly, the thought is maybe you're supporting two people. So those tax brackets are generally going to double, and that's what you see here. So on the next slide, look at this. As an individual, your 10% bracket goes up to 95.25. Well, if we're doubling that, that would be $19,050, right? Look at that. 10% bracket for married filing jointly. On the first $19,050, you pay 10%, so it's exactly double. And you see that relationship with a lot of the brackets that show up here, although not all of them. So you can look at this and spend some more time thinking about it if you want, but the key to realize here is if you're a married couple, for example, you're going to pay 10% on your first $19,050 of earnings. Doesn't matter how much you make. If you make $300,000 on the first $19,050, you only pay 10%. So you face these higher tax brackets as your income increases, but you go through them. So what it's not correct to do, it's not correct to say, well, I'm in the 24% tax bracket, so whatever my taxable income is, 24% times that amount, that's my taxable income. It doesn't work that way. You have to progress through the brackets. And what that means is part of your income is taxed at 10%, part of it is taxed at 12%, and then the rest, if it was under 165, would be taxed at 22%. And because of that, when you average your rate together to get your effective tax rate, that means your effective tax rate is going to be lower than your marginal tax rate. So here we're comparing what happens to people who are married filing jointly and single people with the exact same income. And when that happens, what you see is the deduction, the standard deduction is bigger. There's two people. So you get double the standard deduction. Instead of a $12,000 standard deduction, you get $24,000. And so overall taxable income is going to be lower for the couple, and they're going to pay less in tax. That's because we're representing two people. And it may have taken two people to get to this level of earnings. So that's one way to look at it. So marginal tax rate, I think they explain this in kind of a complicated way. I suppose this is technically correct. To look at what's your new tax liability minus your old tax liability and compare it to your new income minus your old income. And that's one way that you can come up with your marginal tax rate. Another way is to simply look at those tax brackets and to say, all right, the next dollar that I earn, where am I here? Well, if you're between these two numbers, then your marginal tax rate looks to me like it's going to be 24%. If you're between these two numbers, then it looks to me like your marginal tax rate is going to be 12%. If you end up splitting brackets, if you wanted to say, all right, I make $25,000 and I got a $20,000 raise to $45,000. Well, yeah, then your marginal tax rate is going to cross brackets, and that makes it a little bit more complicated. Then you would have to use this formula to figure that out. But unless you're talking about big dollar changes, you can look at your marginal tax rate just by seeing which income tax bracket you're in. Again, when we compare that to effective tax rates, there we're just taking how much do you owe in taxes and comparing it to your income. So we're just dividing, and that's it. So those numbers have to be given to you, and all you're going to do is divide, and there you go. So here they're using the example that was from the previous slide. For a married filing jointly person, they had lower taxes because they had a higher standard deduction, right? So the tax rate, even though the income is the same, they were paying less in tax, so their effective tax rate is also going to be lower. And that's one way you can compare the tax burden for people, is to just calculate their effective tax rate. So marginal tax rate is looking at what tax rate are you facing on the next dollar of income. Effective tax rate says let's look at the whole thing and compare your total taxes to your total income. That's your effective tax rate. Marginal tax rates are typically going to be higher than effective tax rates for that reason, because we have a progressive income tax system. So far we've talked about ordinary income, and these tax rates apply to ordinary income. Capital gains are different. We tax those differently. So a capital gain, what is that? Well, a reminder from last chapter, right? Anything that you buy and then you later sell for more than what you paid for it results in a capital gain. So a lot of times we're talking about stocks and mutual funds. That's traditionally what we think of when we think of capital gains. But there are other categories too. Real estate is one. So for example, if you sell your house for more than what you paid for it, you have a capital gain. The size of that dictates how much, whether or not there's actually going to be a tax on that. But we have different capital gains tax rates than we do from ordinary income tax rates. We treat those two things separately. They're different. They face different tax rates. Here we don't really get into the details of how to calculate capital gains tax rates. But here we talk about, there's more in the book that does talk about that. Here we're just talking about what is somebody's average tax rate. So their effective tax rates, that's what they're asking. So what you do here is, all right, what did they pay in taxes? What was their taxable income? And then you divide those two out, and you'd be able to come up with the average tax rate of, it's going to be 13.7 here if you're dividing the taxes by taxable income. You'd get 9.6 if you were dividing this by your gross income. But traditionally, we don't do that. Traditionally, we're looking at taxable income and what percentage of your taxable income, that's how we figure out your effective tax rate. When we talk about income tax credits, so the government sometimes has certain behaviors that they're trying to encourage, and they might use the tax code to try to encourage certain types of behaviors. For example, maybe there is a tax credit that can be applied to your tuition expenses. We're trying to encourage people to go back and seek additional education. If there's a tax credit to do that, that's how we can incentivize that behavior, through the tax code. The question comes up, are you going to use a refundable tax credit or not? So certain types of tax deductions and tax credits are considered refundable tax credits. And what that means is that it's possible to end up with negative tax rates. If it's a refundable tax credit, if you earn more in credits than you owe in taxes, then you'll actually be given cash from your government. And it's possible that could bring your tax rate down to negative. If you have more that you're entitled to in credits than you owe in taxes, then you'll get a refund from the government, which results in an actual negative tax rate. And you see this at the lower incomes. The bottom two quintiles actually have a negative tax rates. So they're not only not paying federal income taxes, they're receiving refunds because of these refundable credits. It's not entirely fair to look at it this way. There are other taxes that lower income people do have to pay that aren't factored in here, Social Security and Medicare being the big ones, sales taxes. The combination of those two is going to be greater than 9.2% most likely. But that's an academic debate. When you're just looking at the income tax piece, it's possible to end up with a negative tax rate. And that just means that you had more in credits than you owed in taxes. If those credits are refundable, then they'll send them back to you. Some credits are not refundable. And then that means we can reduce your income to zero and you would owe zero taxes, but you're not going to get money back. Oh, okay. And then here on this slide, they're showing the difference between a deduction and a credit. And it is a big difference. Tax credits are way more valuable than tax deductions. A tax deduction reduces your taxable income, and that's a good thing. That's helpful. But a tax credit actually offsets the amount of income tax that you owe. And so here they're comparing those two and kind of showing you the effect on a person In both situations, one person qualifies for a refundable tax credit of $1,000, another person qualifies for a $1,000 deduction. Okay, well, in this case where we have a deduction, yeah, they earn $20,000, they're allowed to not pay taxes on that $1,000. But being that they're in the 10% tax bracket, that means the value of this deduction would be $1,000 times their marginal rate, which here is 10%. So all of a sudden you look at that and you say, all right, well, that's worth $100. Nothing wrong with that. But over here, if instead of $1,000 deduction, you had $1,000 credit, that's actually worth $1,000 because they had net tax due of $800. The $1,000 refundable credit means instead of having to pay $800, they actually get $200 back. So they're way better off to have a credit than they are to have a deduction. So we said that deduction was actually worth $100. The credit is actually worth $1,000, and then hey, look at that. That's the difference in the two is 900. And that's where they get that from, and they've got that helpful frowny face and smiley face to show you which one is better. Obviously, you could figure that out on your own. So we have some income tax credits that are common. Some of them are refundable. Some of them are not refundable, meaning that they can reduce your tax to zero, but they won't result in you getting money back. And so here's an example of some of those credits that show up. We have a couple of education credits. We've got child tax credits, partially refundable there. You have health insurance tax credits, which are mostly refundable. Credit for retirement savings is not refundable. It's a credit, and it's still useful, but it's most useful if you actually end up with taxes owed. Because if you reduced yourself down to zero, that's the best you could do. So refundable tax credits, if you were given a choice, that's what you would prefer. But by law, they've already dictated which credits are going to be refundable and which ones aren't refundable. The next few slides just go into those credits in more detail. I didn't see anything in particular about specific tax credits on the end of the chapter exam. So I'm going to brush over those a little bit. Here's a really interesting idea. One tax credit that's out there is to incentivize the adoption of electric vehicles because electric vehicles tend to be more expensive if everything else is the same. The availability of tax credits makes it possible for those vehicles to be a good deal for the purchaser. It's harder to get there if you don't have access to those tax credits. And so here they've got, if you search online, you'd see it, and then you could go ahead and go through this exercise and see if that would be enough to get you to consider an electric vehicle. But it's a way that we use tax credits. We use the tax code to incentivize people's behavior. And that's not uncommon for the federal government to do that in a number of areas. So I've never seen this described this way before, but I guess there's nothing wrong with saying it this way. If you're trying to decide, are you an employee or are you self-employed? Well, when you're self-employed, you are in control of what you do, and you're typically charging for your products and services that you're selling. So usually that's the easiest way to tell. But I suppose another way to tell would be to look at your Social Security and Medicare taxes. If they're being withheld from your paycheck, you're an employee. If there are no Social Security or Medicare taxes withheld from your paycheck, then yeah, you're self-employed. And what that really means is that you will have to pay both halves. The Social Security and Medicare taxes are split between the employer and the employee. So as an employee, you're paying 6.2% for Social Security, you're paying 1.45% for Medicare, you're paying 7.65% in total as an employee for those two. Your employer has to match that. So if you're self-employed, you're both the employer and the employee. So you're paying 6.2% for Social Security as an employee. You're matching it as an employer, 6.2%, so we're up to 12.4%. For Medicare, you're paying 1.45% as an employee, and then you have to match that as an employer, another 1.45%, total of 2.9%. So if you want to know what the total amount of payroll taxes is for an individual, the employer is paying 7.65%, and so is the employee. When you're self-employed, you're paying the whole thing. That's 7.65 plus 7.65. It gets to be 15.3% in total. And if you're self-employed, that's how that works. If you're an employee, at the end of the year, you get a W-2, which reports your earnings and what was withheld. If you're self-employed, you get a 1099 from the people who you charged money to for products and services. Then they'll report that back to the IRS. So your employer and the people you charge, if you're in business for yourself, those people are reporting your income to the IRS, and then there's a check done to make sure that what you report on your tax return matches what other people say they paid you. And that's part of the tax return process that you deal with through the IRS. Here's an example of what a W-2 form might look like. Here you've got $20,000 in wages. They've withheld some federal income tax. 6.2% of $20,000 is $1,240. That's what they've withheld for Social Security. They're matching another $1,240. You don't see that anywhere. That's what the employer has to pay. Medicare tax on $20,000, 1.45%, the piece that you have to pay, they're going to withhold $290 from that amount. And so on your W-2 at the end of the year, you should see something like this. And then we've got a withholding for state income tax down here too. If you were getting a 1099, so here you're an independent contractor, here you're a self-employed individual, you did a project for somebody and you charge them $20,000, they're going to report that. And here it's box 7, it's non-employee compensation. So they're reporting that to the IRS. They're sending a copy of this form, and then they're also sending a copy to you to remind you that, hey, this has to be included in your income for the year so that it matches. When you're self-employed, here's our percentage. You got to pay 15.3% of income, as long as your income is more than $400 and less than, this year it's actually $132,900. So there's a limit on Social Security taxes. You pay, as an employee, you pay 6.2% up to $132,900. If you happen to earn more than that, then on the amount over that, you don't owe any Social Security taxes. Medicare, on the other hand, you pay all the way up. There is no cap. So a Medicare tax, whatever your income is, you pay 1.45% as an employee. If you're self-employed, you got to pay both the employee and the employer piece. So there it's 2.9. So 2.9 Medicare, 12.4 Social Security, 6.2 on each side. You add that 12.4 and the 2.9, you get 15.3. That's the magic number that accounts for payroll taxes on both sides. So, and here we see this again. So the total Social Security tax rate is 15.3. Half is paid by the employer, half is paid by the employee. If you're self-employed, you get to pay the entire amount yourself. So one of the things that we think about when it comes to lowering your tax base has to do with when you realize income and when you recognize it. And the simplest way to distinguish is to be able to say that recognized income, that's when it's taxed. Realized is when you actually had the transaction take place. So it is possible to have a transaction in 1 year that you realize and you don't recognize it to the following year, particularly for business owners. This isn't uncommon. Every business has to figure out, based on the type of accounting system they're going to use, whether it's cash or accrual, every business has to figure out how they're going to handle things that happen at the end of the year. And there we may have a mismatch between which year we realize income in and which year we recognize it in terms of that's when we pay taxes. So that's the easiest part. Recognized income, that means you're paying taxes on it in that year. Realized income is when the transaction actually happens. There's a couple other things that happen where you can get compensated in a way that gives you an additional tax advantage. Most employee benefits are going to be tax advantaged. In other words, if your employer pays for your health insurance, that's not included in taxable income to you. So that's hugely valuable. Money that your employer puts into your retirement plan on your behalf, that is not recognizable as taxable income to you. That's super valuable there, and it ends up creating changes in this realized and recognized income. So in general, employee benefits are going to be tax advantaged. So the typical strategy that we tell people is, up to some point, you need additional income to meet your needs. Once you've gotten beyond that point, you are probably better off receiving whatever compensation you can in the form of employee benefits because it's not taxable. So having non-taxable elements of compensation isn't helpful when you need your money to survive day to day. But once you get beyond that point, now there's a huge tax advantage by having your employer provide your compensation in the form of employee benefits. And so that can be really valuable to know. So certain investments are going to contain a tax advantage. There's a bunch of different examples here. We've got 529 savings plans. That's usually people saving on behalf of their children to go to college. Or it wouldn't have to be your child. You could establish a 529 for somebody else to help them save for college as well. Your primary home The value change in here is usually sheltered from taxes up to a certain amount. There's a limit. But if you have a capital gain from selling a home, um, that's very likely to be non-taxable, especially at the lower edges of income. At the higher edges of capital gain that we're talking about from selling a home, if you made an additional $1 million from selling a home, part of that would not be tax-free. But for a middle class family, selling their home usually will not result in a tax liability. So that's one way that you can save tax free, is to invest in a home, with the idea that at some point in the future you're going to sell it and you hope to sell it for more than what you paid for it. That's a capital gain, but it's probably a non-taxable capital gain unless it's huge. Retirement accounts often are saved on a tax-free basis. You're going to want to review the timing of the tax break in a Roth IRA and a traditional IRA. There's a question on the end of the chapter exam that deals with that I want you to be prepared for. The timing is the difference. Just a reminder, a traditional IRA, you are allowed to get your tax break today. In other words, if I put $5,000 into a traditional IRA and I earn $50,000 this year, I'm taxed as if I earned $45,000. Then if I do this every single year, that account will grow. That'll help provide for my retirement. When I take money out, I pay taxes on it. The other way to do it is the Roth IRA, and that means that when you put money in, you don't receive an immediate tax break. But when you take this money out of the retirement account, it'll be tax-free. So we're just flipping the timing of the tax break. So for a traditional IRA, you get your tax break right now in this year. In a Roth IRA, you get your tax break in the future. And in terms of which should you choose, it depends on what is your tax rate now and do you expect it to be higher or lower in the future. Health savings accounts are similar, except they give you some additional tax benefits if the money that's saved here is used for qualified medical expenses. So anything related to those types of things, you need to be able to keep some records, and that's what they talk about here. So after you've reviewed that, you should check, are there things in here that could result in tax breaks, and are there additional records you need to be keeping? That's something that makes sense to at least consider. All right, so on review, you should, if you've watched this lecture and taken good notes, I would say that you should be prepared to take that end of the chapter exam. And that's the pattern that I'll continue to follow, is that's what's helping me choose what to emphasize when I go through and record these lectures, is what's coming back that you'll have to be prepared for. So thanks a lot for watching, and we'll see you next time.